Okay, let's unpack this. We're going to do a deep dive into the latest results from one of North India's biggest healthcare providers, Yatharth Hospital. We've got their Q2 and H1 results for fiscal year 26, which just came out on November 13th, 2025. And there's a lot to get through.
There really is. I mean, we've got the press releases, the investor presentations, and they all paint this picture of, well, really aggressive expansion.
Exactly. And our mission today is to kind of filter through all those numbers and really map out their growth strategy for you, because it's not as simple as just growth is good.
Not at all. What's so fascinating here is how the company is managing this massive capacity expansion while at the same time keeping their core business incredibly profitable.
So we need to figure out where the revenue is really coming from.
And how quickly their huge new assets can, stop being a drag on the numbers and start contributing in a big way.
Okay, so let's start with the big numbers. The consolidated financial snapshot for the quarter ending September 30th.
The headline figures.
Right. Operating revenue hit a record. It was Artist $2,794 million. That's a 28% jump year over year.
Which is incredibly robust.
Right.
And the profit after tax, or Pocanic cart, that grew even faster. It climbed 33% to Artist, $413 million.
EBITDA was also a record. Ours is $645 million, up 18%. So on paper, it's just, a fantastic growth story.
It looks perfect.
And this is where we hit our first kind of analytical speed bump, right?
This is the interesting part.
If you look closer, the reported consolidated EBITDA margin actually dipped slightly. It went down to 23.1%.
Yeah, that's a 200 basis point drop compared to last year. And that's the kind of thing that should make you ask questions.
It absolutely should. Record revenue, record profit. So why are your profitability margins slipping?
It's a great question. Does it mean costs are running out of control? Or that maybe, just maybe, these brand new hospitals are proving more expensive to get going than they thought?
Well, the sources actually give us a pretty clear answer. They seem to be saying this dip was, if not intentional, then at least fully expected.
It's the cost of doing business when you're growing this fast. The whole story is in separating the mature, established assets from the brand new ones.
The ones that are still in that cash burn ramp-up phase.
Exactly. You have to strip out the financial drag from those new facilities, specifically the ones in Delhi and Faridabad Sec 20. Once you do that, the picture changes completely.
Okay, so let's talk about those adjusted figures, because this is really the aha moment of the whole release.
It really is. When you take out the drag from those new hospitals, the adjusted EBITDA margin wasn't 23.1%. It was 26.7%.
Wow.
And it gets better. The adjusted profit after tax, it saw just a remarkable 63% year-over-year increase. It hit ours $504 million.
So what that tells you then is that the underlying business, the mature hospitals, are just incredibly strong.
They're a cash machine. They are so profitable that they can easily carry the startup costs of these massive new sites. It basically proves the business model works beautifully once you get the hospitals full.
Which gives them this tremendous license to be so ambitious with their expansion. Okay, so let's do a deeper dive on the operations. How are they sustaining that strong base?
The split in performance is, it's really telling.
Okay, so the mature hospitals, they showed a solid 19% revenue growth year over year. And what's more important, their occupancy was at 72% in the quarter.
And that 72% number, that's a really key metric for you to watch. In hospital management, that's considered, pretty close to optimal.
Why is that?
Well, once you get much higher than that, you start running into all sorts of logistical problems, staffing, scheduling, not enough beds in the ICU. So sustaining 72% shows they're running a very efficient ship.
Meanwhile, the new hospitals are where you see the just exponential growth, a massive 110% YoY increase in revenue.
And we can already see their model is working fast. I mean, look at the Greater Faridabad facility. It's only been fully operational for a year. And it already contributed 10% to the group's total revenue in the quarter. That kind of speed, to get to that level of contribution, it suggests they have their launch playbook down perfectly.
Okay, so beyond just filling beds, there's another metric that tells us what kind of patients they're treating, right? The ARPOB.
Right, average revenue per occupied bed. And that confirms they are absolutely moving toward more complex, high-value cases.
So the overall group ARPOB was about ours, 32,000, up 4%.
Yeah, but again, you have to break it down. In the mature hospitals, it grew by a solid 9%. But in the new hospitals, It was up a staggering 19% year over year.
A 19% jump. So they're not just filling these new beds with, routine procedures,
Not at all. That kind of jump confirms they are immediately focusing on high-value super specialties.
which we can see very clearly in the data for their flagship site, Noida Extension. It has the highest ARPOB of all at almost 41,000.
And that's because of the specialty mix. I mean, look at oncology. It's not just a small department. It makes up 10% of the entire group's revenue.
And at that one facility, Noida Extension, it's 18% of their revenue.
Exactly. And you see the same focus across neurosciences, nephrology, cardiology. They're building these complex medical hubs, not just community hospitals.
Which brings us to their forward-looking strategy, this aggressive capacity expansion. They actually describe themselves as being ahead of schedule.
It really is a blitz. They're trying to rapidly build up their network density in North India because they know that scale is what creates efficiency and attracts the best doctors.
So they kicked off the quarter by opening their New Delhi facility in Model Town, that was back in July, added 300 beds.
And it opened strong, with an immediate ARPOB of over 33,000.
Then, just a few months later, in November, they opened another facility in Faridabad, another 400 beds.
So that's 700 new beds brought online in, what, 4 or 5 months?
Yeah.
I mean, think about the logistical challenge of that. Finding the nurses, the technicians, the specialists at that kind of pace.
It's a huge challenge. But their strategy seems designed to solve that problem, which brings us to the acquisition in Agra, the Shanti Hospital.
Right. And this is so much more than just buying another building. This is a really strategic move.
Okay, so the deal added 250 beds, expandable from 150, for about Rs. 2,600 million. But you're saying the location is the critical part here.
Absolutely. It's right on NH19 near the Yamuna Expressway. So when we talk about a feeder hospital, what does that actually mean for patients and for the business?
Yeah, explain that.
A feeder hospital is like a highway on-ramp to their high-end metro services. A patient in the Agra region might go to Shanti V for their initial diagnosis. But if they need something really complex, like, say, advanced cancer treatment or an organ transplant...
You get transferred directly to one of the super specialty centers in Noida or Delhi.
Precisely. So those 700 new beds in Delhi and Faridabad aren't just waiting for local walk-in patients. They've built a patient funnel from Agra to make sure those new expensive assets get filled with high-value cases right away.
Which accelerates their path to that crucial 72% mature occupancy rate we talked about.
Exactly. It all ties together. So with these moves, their total capacity is now over 2,550 beds across 8 hospitals. The strategy is crystal clear.
Okay, and speaking of clarity and confidence, it wasn't just about building new wings this quarter. They also focused a lot on governance and external trust.
Which is so important when you're growing this fast and trying to attract big institutional money. You have to build trust just as fast as you build capacity.
So one big piece of news was resolving an old income tax issue. The authorities released an attachment on their properties and deposits.
Which is huge. It just clears a legal overhang, removes uncertainty for investors. It's like wiping the slate clean.
They also upgraded their whole institutional framework. They brought in a BDO international firm as their statutory auditor and a healthcare veteran, Mr. Ramesh Krishnan, as an independent director.
Both moves signal to the market that they're serious about elevating their governance to match their new scale.
And the market responded. CRISIL upgraded their credit rating to a stable.
Which reflects, a real confidence in their financial stability, even with all this spending on expansion.
But then came the validation that might be the most interesting for global investors.
Oh yeah, this is a big one. The inclusion in the MSCI India Small Cap Index.
Why is that such a game changer?
Well, being on an MSCI index basically means you are now automatically on the radar of massive international index funds. It puts you on the map for global institutional investors in a way that almost nothing else can. It's a huge boost of visibility.
And that global mindset, you can also see it in their next big strategic push,
Wow.
medical value travel or MVT.
Right. They're actively chasing international patients, and they're highlighting their proximity to the new Noida International Airport as a key advantage.
And it's not just talk. They're building actual partnerships to create these patient funnels from other countries.
Yeah, you see a cardiac partnership in Ethiopia, health camps in Uzbekistan and Tajikistan. They're even planning to launch information centers in places like Tanzania, Kenya, and Mauritius.
It's a very deliberate, targeted effort to make sure those super specialty beds are filled with international patients who are, willing to travel for that complex care.
Absolutely.
So to wrap this all up, what we've seen is Well, impressive revenue and profit growth, all driven by this incredibly strong core of existing hospitals.
Right. And we've mapped out the massive integration challenge, but also the huge eventual financial upside of bringing 700 new beds online so quickly.
And we've seen how that smart M&A move in Agra helps solve the utilization puzzle. On top of all that, you have governance upgrades and huge external validations like that MSCI inclusion.
It all paints a very compelling picture. But it also raises a really important question for you to consider as you think about this.
Okay.
They've rapidly added over 1,100 beds in total between the new facilities and the Agra acquisition. The entire success of their financial model now hinges on one thing.
Which
How quickly can they get these new assets to that mature occupancy level of 72%? If they can hit that utilization rate faster than the market expects, then those massive adjusted EBITDA margins we talked about, the ones currently hidden by startup costs, they become reality.
And that would dramatically reshape their entire profitability profile.
Exactly. That's the real challenge ahead for the company and a fascinating point for you to explore further.
Thank you for joining us for this deep dive.